When you picture your future, do you see financial security? Imagine a life where you're not just getting by, but thriving, where your money works for you, not the other way around. That's not just a dream, it's a goal you can achieve with a plan. It all starts with setting clear intentions and mapping out the steps to reach them. A key part of that plan is long-term investing, putting your money to work today so it grows for tomorrow. Just like planting a seed, your investments need time and care to flourish. You're not chasing quick wins, you're building a foundation for retirement, your children's education, and financial freedom. These are the milestones that shape a secure and fulfilling life. The world of investing can seem overwhelming, with options like bonds, real estate, mutual funds, and today's focus, gold and stocks. Each has its own risks and rewards, and understanding them is crucial. People have debated gold versus stocks for generations. Both have unique qualities and have played important roles in building wealth across history. The right choice depends on your goals, timeline, and comfort with risk. Are you looking for stability, growth, or a balance of both? Understanding each investment is the first step to making a confident decision. The more you know, the more empowered you'll feel to take action. Think of your financial life as building a house. Long-term investing is the foundation. Without a strong base, everything else is at risk. Without it, unexpected events like job loss or market downturns can shake your finances. But with a solid plan, you can weather those storms and stay on track. By investing for the long term, you give your money the gift of time to recover from downturns and to benefit from compounding. This is how small, consistent steps can lead to big results. True wealth is built not by timing the market, but by time in the market. Patience and discipline are your greatest allies. So let's dive in. We'll break down gold and stocks, what they are, how they perform, and their strengths and weaknesses. You'll learn how each can play a role in your portfolio. My goal is to give you the knowledge to feel empowered. When you understand your options, you can make choices that truly serve your future. By the end, you'll see how gold and stocks might fit into your plan. You'll be able to weigh the pros and cons and decide what's right for you. You'll be able to say, I understand my choices and I'm ready to build my secure future. Let's get started on this journey together. Your financial future is in your hands. Make it strong, make it lasting, and make it yours. Let's talk about gold, a rare, beautiful metal that doesn't rust, tarnish, or corrode, making it unique among the elements found on Earth. Its natural luster and shine have fascinated people for centuries, and it's been used in everything from jewelry to currency. Gold has been valued for thousands of years, treasured by ancient civilizations and modern societies alike. From the tombs of Egyptian pharaohs to the coins of the Roman Empire, gold has always symbolized wealth, power, and stability. Gold's long history makes it the ultimate store of value, especially when trust in paper money fades or economies face uncertainty. When markets are volatile, people often turn to gold as a safe haven for their wealth. You don't need to be royalty or a billionaire to invest in gold. Today, anyone can add gold to their portfolio, whether you're just starting out or looking to diversify your investments. The most direct way is buying physical gold, coins or bars, that you can actually hold in your hand. These can be stored at home in a safe or kept secure in a professional vault, depending on your preference. But owning physical gold comes with its own set of challenges, like finding a safe place to store it and making sure it's properly insured against theft or loss. If that's not for you, consider gold ETFs. These are funds that actually hold gold and let you buy shares on the stock exchange, just like you would with stocks or mutual funds. This is a convenient, modern way to invest in gold without ever having to handle the metal itself. It's easy to buy and sell, and you can do it all from your phone or computer. Another option is gold mining stocks, which let you invest in companies that search for and extract gold from the earth. Here, you're not buying gold itself, but rather shares in companies whose fortunes rise and fall with the price of gold and their own business performance. These stocks are tied to gold's price, but also depend on company management, mining costs, and other risks. Gold investing isn't one size fits all, and each method has its own unique factors to consider. Each method has its pros and cons, so it's important to weigh your options carefully and think about what fits your needs best. Choose the approach that matches your comfort level, investment goals, and how involved you want to be in managing your gold assets. Gold's value endures through the ages, offering security and stability, but ultimately, how you choose to invest in gold is entirely up to you. Now let's talk stocks. A stock is a piece of ownership in a public company, When you buy shares, you become a part owner. If the company grows and profits, your investment grows too. Stocks represent active businesses creating real economic value. Over the long term, the stock market offers significant growth potential. You can buy individual stocks, but that requires research and carries risk. Diversification is key. Don't put all your eggs in one basket. For most, mutual funds or ETFs are smarter. They hold many stocks, spreading out risk. For example, an S&P 500 index fund gives you instant diversification across top US companies. This approach is simple, low cost, and forms the foundation of a strong investment plan. Stocks let you participate in economic growth. With discipline and patience, they can help you build real wealth. Start with broad funds and let your money grow with the market. To make smart choices, let's look at history. Understanding the past performance of different assets can guide us in making informed decisions for the future. Since the 1970s, gold has grown in value, but broad stock market indexes like the S&P 500 have delivered much higher long-term returns. This is evident when we compare their historical charts. Why? Stocks are ownership in businesses that generate profits, pay dividends, and reinvest for growth, creating compounding returns. This continuous cycle of reinvestment and profit generation is a key driver of stock market growth. Gold, by contrast, doesn't produce income or innovate. Its value depends on what others will pay. It's a tangible asset, but it doesn't generate cash flow. Stocks are wealth-creating engines, while gold is a store of value. This fundamental difference shapes their roles in an investment portfolio. The stock market can be volatile in the short term, with big swings and crashes. These fluctuations can be unsettling, but they are part of the market's nature. But over decades, its trend is upward, reflecting economic growth. This long-term perspective is crucial for investors. Gold's performance is more erratic, long flat periods, then sudden spikes during crises. These spikes often occur during times of economic uncertainty. Gold is less about steady growth and more about insurance against chaos. It acts as a hedge during turbulent times. Both assets behave differently in different environments. Their unique characteristics can complement each other in a diversified portfolio. Understanding this helps you decide how they fit in your plan. A well-thought-out strategy considers the strengths and weaknesses of each asset. History shows stocks build wealth. Gold preserves it. This distinction is key when planning for long-term financial goals. The right mix depends on your needs. Your risk tolerance, investment horizon, and financial goals will determine the best allocation. Let's weigh the pros and cons. By understanding the historical performance and characteristics of gold and stocks, you can make more informed investment decisions. Gold's biggest advantage? It's tangible and universally valued even in crisis. It acts as a hedge against inflation and a weak dollar, and often rises when stocks fall. Gold is a safe haven during economic or political turmoil, but gold doesn't generate income, no dividends, no interest. Its long-term returns lag behind stocks because it just sits there. Physical gold brings storage, insurance, and selling hassles. Costs can eat into returns, and selling isn't always quick or easy. Gold is not as simple as it seems. It's best seen as insurance, not a growth engine. Weigh these factors before investing. Gold's role is protection, not wealth creation. Stocks' greatest strength is long-term growth. No other asset class matches their returns over decades. You own a piece of the economy's productive power, benefiting from innovation and compounding. Index funds and ETFs make investing easy, low-cost, and accessible. Diversification across industries reduces risk. But stocks are volatile. Prices can swing wildly and crashes can be scary. Emotional discipline is essential. Panic selling leads to losses. Stocks are for long-term goals, not short-term needs. Picking individual stocks or timing the market is risky for most people. Stick to a plan, stay invested, and focus on your goals. Stocks reward patience and discipline. Let's see how gold and stocks perform in real crises. In the 1970s, high inflation hurt stocks, but gold soared. In the 1980s and 1990s, stocks boomed while gold stagnated. During the 2008 financial crisis, stocks crashed, but gold rose, cushioning losses for diversified investors. After the crisis, stocks entered a long bull run, far outpacing gold. These examples show no single investment wins in every environment. Stocks thrive on growth and optimism. Gold thrives on fear and uncertainty. Their performances often mirror each other. The lesson? Diversification matters. Use both to balance growth and protection. History rewards those who prepare for all seasons. Don't bet everything on one asset. Build a resilient portfolio. So, gold or stocks? The answer depends on your goals and risk tolerance. Stocks are like the hare, fast, exciting, but volatile. Gold is the tortoise's shell, slow, steady, and protective. Ask yourself, is your goal to grow wealth for decades or to protect what you have? Can you handle big swings in your portfolio, or do you lose sleep over volatility? Most people need a mix: stocks for growth, gold for insurance. Diversification is key. You don't have to choose just one. For long-term wealth, most of your portfolio should be in stocks and bonds. A small allocation, 5 to 10% to gold, can smooth out the ride during crises. Balance is the goal. Know yourself and build a plan you can stick with. Your comfort with risk shapes your investment mix. The best portfolio is one you can hold through any storm. We've explored gold and stocks, their roles, and how they perform in different climates. There's no one-size-fits-all answer. Your plan must fit your goals, timeline, and risk tolerance. Think of your financial house. Stocks and index funds are the foundation for long-term growth. You need this engine to outpace inflation and reach your biggest goals. But every house needs a roof. Gold can be that protection during storms. A small allocation to gold acts as insurance, not a growth driver. The power to build your future is in your hands. Start with a simple, diversified plan. Index funds are a great foundation. As you grow, consider adding gold if it fits your needs. The key is to start, stay consistent, and build a house that lasts a lifetime. Be smart, be strong, and be secure. Your financial future is yours to build. Make it resilient,